Hey there, Washington public employees. Have you checked your DCP balance lately? I sure hope not. All jokes aside, if you are looking at your DCP balance on a regular basis, as you see those fluctuations, those could be concerning. Those could cause anxiety. Those could be something you want to be aware of. And so in today's video, we're going to get into some of those strategies and some of those reasons about how we can kind of manage our anxiety if we're looking at our retirement account balances and really concerned about seeing those fluctuations. The big thing to keep in mind as we discuss this is that part of investing over your career is that you have long time horizons. And even as you get closer into retirement, you have long time horizons. And unfortunately, the stock market goes up, down, up, down, up, down, but it continues to go up over time, even though it's got kind of a squiggly chart to it. It's not smooth, it's not flat, but it does go up. For those of you that don't know me, my name is Seth Thiel. I'm a CPA and financial advisor with Life Focused Financial Advisors. I'm also a former city employee, and I absolutely love helping public employees in the state of Washington navigate their financial futures. And my promise to you is that we're going to talk about a clear action plan today to help protect your retirement savings while they continue to grow. The first key point that we want to get into today is we want to really reframe market volatility and how we think about our investments. And the reason we want to do that is it helps alleviate some of that worry. And I'm not saying you shouldn't be worried when or like have some level of anxiety when you see a 20% decrease in your savings. However, we really want to reframe those big decreases and that your portfolio hasn't lost money. As long as you haven't sold and you're still invested, your portfolio has not lost any money. The only time you would actually see a loss is if you sold and took your money out of the market. And so that gets us to a really important point that we want to make sure during those points of volatility, we stay in the market. There are a lot of statistics out there. I saw one from JP Morgan that said just missing the 10 best market days over the last 15, 20 years cut returns in half. So it's really important to stay invested, keep your money in the market through all those ups and downs. One way that you can help navigate some of that volatility, especially during your working years, is through those regular DCP contributions. So those contributions you're making each paycheck, whether that's twice a month, once a month, weekly, whatever your pay schedule is, you're regularly putting money into your 457B, or if you're a PERS 3 member, the investment side of PERS 3, you're regularly putting money into those investments, and you're essentially dollar cost averaging those investments over time. The next component that we want to talk about is we want to leverage some of those DCP, that 457B you have access to, whether it's DRS or Nationwide or Mission Square. Your deferred compensation program has, in a sense, built in ways to protect you from those volatile changes. Now, I'm not saying they're going to completely smooth everything out. However, with your whatever your DCP provider is, keep in mind that there are different investment selections available. And so those can help smooth out having a diversified equity allocation can really smooth out some of those volatile times that we see. Now, they're not going to completely smooth it out, but if you have a little international exposure, that can help balance out the US markets during those volatile times like we've seen recently. And so keep that in mind that there are tools and options available. Now, the next key item that we want to hit on is how does our asset allocation, how much stock and how much bond do we hold, and how does that need to change as we get closer to retirement? For everyone, it's going to be a little bit different, so keep that in mind. However, one thing for if you're listening to this, you're probably a public employee in Washington State and you likely have a pension. Keep that in mind that you have that fixed, stable pension income, and that can really provide a solid foundation. But as you get closer to retirement, you want to start to tweak the amount of stock and the amount of bond you have. You want to have a little bit more bond. Ultimately, you want to think about how much of this money am I going to use in the next 5 years? If you're going to use it in the next 5 years, you generally don't want that in the stock portion or the equity portion of your investment portfolio. You want to have that in a combination of bonds and cash. So keep that in mind that we want to slowly adjust things as we get closer to retirement. Now we want to shift and start to think about what opportunities come up when we see some significant down markets. There are lots of tactical strategies that you can employ to help manage those times as well as take advantage of some of those down market opportunities. So before we jump into some of the key things you can do to take advantage of those market downturns, we want to think about what's our strategy for when the market inevitably goes down. We know the market's going to go down. It's not a matter of if, but when. I saw a really interesting statistic the other day that the chance of you experiencing a significant market downturn increases as the amount of time you're invested increases. And that makes sense because we know down markets happen on a regular basis. So we know over, let's say, a 20-year period, the chance of you seeing at least one bear market during that time is extremely high. So we know it's not a matter of if, but when. So how do we navigate that? One of the things that we like to do for our clients is we like to use a guardrail style strategy and we like to build a war chest. So anything we're going to use in the next 5 years, that money is not invested, and that's the war chest for our clients. So that's one strategy that you can use to help feel a little peace of mind. Even if we see a significant market downturn, let's say we see a significant 2008 type situation, again, at some point, we know we're going to be able to get through that. So that's just one strategy. Again, lots of different strategies, tactics out there to help get through that. But you want to have something to lean on when those markets go down. And so as we get to that down market time and we feel good about our strategy, we feel like it's going to get us through that kind of scary time. What are some things we can do during that time to really kind of amplify our returns? Well, first off, if you have the ability, if you have cash laying on the sideline that you're not using and you're not going to be using the next 5 years, you can go ahead and deploy that. You can invest that. Investing at a lower point in the market can really boost your returns. Another thing to consider is, let's say you just retired, you retired early, and you just started pulling your pension. So your income has really dropped quite a bit in retirement, and we have a down market. So that can definitely be a scary time. But one of the things you can consider doing during that time is what are called Roth conversions. I'm not going to get into all the nuances of Roth conversions. However, if you can do those at a lower market point, you're essentially being able to do those more cheaply. In any taxable brokerage accounts, you can also consider tax loss harvesting. However, keep in mind that there are a number of rules around tax loss harvesting. I'll do another video getting into the nitty gritty of those at some point. But keep in mind that wash sale rules can impact your tax loss harvesting. Thanks for tuning in today. In wrapping up this video, we want to really have a system in place. We don't want to be predicting. We don't want to be guessing. We don't want to be relying on our own emotions during those down markets. We want to have a concrete strategy to really be able to navigate those down markets and get through those tough times. So I like to always leave us with a few action steps. Go ahead and log into your DRS account through Voya and get into your Voya and see what your DCP allocation is. Or if you're Nationwide or Mission Square, go ahead and look at what your allocation is and make sure that aligns with your goals. So what's the amount of stock you have? What's the amount of bonds you have? and kind of keep that in mind. One note on asset allocations, a lot of folks are in target date funds or the tap allocation through DRS. Keep in mind that those two options aren't as flexible, especially once you get into retirement. One of the keys with some of the things I've talked about today is that you can pull money out of a specific investment. So let's say the market's down and we want to pull from our bond portion of our investment portfolio. We want to be able to do that in a down market. If you're in a target date fund or the TAP, you can't do that. So keep that in mind. Then we also want to take a look at our emergency fund. Make sure your emergency fund is built up to help get through any kind of significant expenses that you might not be expecting. And remember that the only time you make losses permanent in your portfolio is when you sell during a down market. And what I mean by that is when you sell a growth oriented investment. So when you sell an equity portion of your portfolio that's down, that's when you actually lose money. Not if you're selling a bond portion that's been relatively stable or a stable value portion that hasn't lost any value. So keep that in mind that we're only losing money in a down market when we sell. And then make sure all of this, what I like to do with folks is kind of take the Tums test. Do you need to pop Tums to be able to navigate any uncertainty? And if that's you, you want to look at that asset allocation and potentially add some more bonds. So keep those things in mind as you're looking at your DCP and figuring out whether your current asset allocation makes sense for you. Thanks for tuning in today. If you ever want to learn more about potentially working together, go ahead and head over to lifefocusadvisors.com. I also have a complimentary guide in the link below going over some of the common mistakes I see folks making, so be sure to download that.